When people hear debt, they usually think of something to avoid: credit card bills and high interest rates, maybe even bankruptcy. But when you're running a business, debt isn't all bad. In fact, analysts and investors want companies to use their debt smartly to fund their businesses. The debt to equity or DE ratio is used to evaluate a company's financial leverage and is calculated by dividing a company's total liabilities by its shareholder equity. The DE ratio measures the degree to which a company is financing its operations through debt versus wholly owned funds. But more specifically, it reflects the ability of shareholder equity to cover all outstanding debts in the event of a business downturn. The debt to equity ratio is a particular type of gearing ratio. It's a simple measure of how much debt a company uses to run the business. The ratio tells you for every dollar you have in equity, how much debt you have. It's one of a set of ratios that can be called leveraging ratios that let you see how and to what extent a company uses debt. Don't let the word equity throw you off here. This ratio isn't just used by publicly traded companies. Every company has debt to equity ratio, and any company that wants to borrow money or seek investors should be paying attention to it. Figuring out a company's debt to equity ratio is a fairly straightforward calculation. You take the company's total liabilities, what it owes others, and divide it by equity. This is the company's book value or its assets minus its liabilities. Both of these numbers come from your company's balance sheet. Here's how the formula looks. So let's say an example where a small business owes 2,736 to debtors and has $2,457 in shareholder equity. The debt to equity ratio is 1.11. So of course the question is 1.11 a good number? Some ratios want you to be as high as possible, such as profit margins. In those cases, higher is always better. But with debt to equity, you want it to be a reasonable range. In general, if the debt to equity ratio is too high, it's a sign that the company may be in financial distress and unable to pay its debtors. But if it's too low, it may be a sign that the company is over relying on equity to finance its business, which can be costly and ineffective. A very low debt to equity ratio puts a company at risk for a leveraged buyout. Think about this in the context that companies have two choices to fund their business. They can either borrow money from lenders or get money from equity. Interest rates on business loans tend to come with an array of interest rates, and that interest is often deductible on the company's tax returns, making it an attractive way to fund the business, especially when you compare it to the returns that you as an investor might expect when you buy your stock that shows up equity on your balance sheet, which could be 10% or higher. So you need to compare this figure against other businesses in the same field or industry because different industries will have a very different standard for a good balance. Tech companies and those that do a lot of research and development tend to have a ratio of 2 or below. Large manufacturing and stable publicly traded companies have ratios between 2 and 5. In the banking industry, it's not uncommon to see the ratio between 10 to 20, but that's unique to those industries and a great example of why you need to compare apples to apples. This calculation is most often used by bankers or investors deciding whether to give your company money. It helps them understand how you're paying for your business. Does the company have the ability to develop revenue, profit, and cash flow to cover expenses? If the debt to equity ratio goes up, the perceived risk goes up. If the company doesn't make its interest payments, the bank or lender can force them into bankruptcy. Bankers, in particular, use the debt to equity ratio in conjunction with other measures like profitability and cash flow to decide whether to lend the company money. They'll often know from experience what an appropriate ratio is for a company of a given size in any particular industry. From the perspective of the company you are analyzing, the reality is that most managers likely don't interact with this figure on a day to day basis. But as an investor, it's helpful to know what the company's ratio is and how it compares with competitors. It can also be a handy gauge of how senior management is going to feel about taking on more debt and therefore whether they can take an extra project that requires taking on more debt. A high ratio means they're likely to say no to raising more cash through borrowing. It's also important for managers to know how their work impacts the debt to equity ratio. There are lots of things managers do day in, day out that affect these ratios. How individuals manage accounts payable, cash flow, accounts receivable, and inventory. All of this has an effect on either part of the equation. This type of analysis is going to combine the quantitative debt to equity figure with something very qualitative, but also very important to you as an investor to look into management of the company. While there's only one way to do this calculation, it's pretty straightforward. There's a lot of wiggle room in terms of what you include in each of the inputs. What people include in liabilities will differ. For example, some financiers take non interest bearing debt, such as accounts payable and accrued liabilities, out of the liability number, and others might look at short term versus long term debt in comparison to equity. So find out what exactly the company you are looking into counts in its calculation and do your own calculations to confirm. Healthy companies use an appropriate mix of debt and equity to make their businesses successful. The debt to equity ratio is a valuable tool for entrepreneurs and investors, and it shows how much the business relies on debt to finance its purchases and business activities in relation to the equity it uses for the same purposes. A higher DE ratio may make it harder for a company to obtain financing in the future. This means that the firm may have a harder time servicing its existing debts. A very high DE can be indicative of a credit crisis in the future, including defaulting on loans or bonds or even bankruptcy.